Today, the Insider exclusive will explain that the best way to understand the financial crisis is to understand the meltdown at AIG. It was the perfect storm where Washington met Wall Street. In the 10-year period beginning in 1998, financial companies spent $1.7 billion in federal campaign contributions and another $3.4 billion on lobbyists. They quickly got what they paid for. AIG spent more than a decade systematically scheming to evade U.S. and international regulators while making colossal, world-sinking $500 billion bets with money it didn't have in a toxic and completely unregulated derivatives market. When AIG finally got up from its seat on the Wall Street casino, it owed money all over town. This was a casino where middle-class taxpayers cover the bets of billionaires. The reality is that the worldwide economic meltdown cemented and formalized a political trend that has been snowballing for decades: the gradual takeover of the government by a small class of connected insiders who use money to control elections, buy influence, and systematically weaken financial regulations. As complex as all the finances are, the politics are not hard to follow.
Hi, I'm Steve Murphy, and this is the Insider Exclusive. Today, we take a special look at what's wrong with America's financial system with our special guests, Andrew Entwistle, the managing partner of the law firm of Entwistle and Capucci, and Bill Black, a former SNL regulator and best-selling author of The Best Way to Rob a Bank is to Own One. Stay tuned. I am very pleased to have with us in this round table today Andrew Entwistle, managing partner of Entwistle and Capucci. Welcome to the show.
Steve. Thank you.
And Bill Black, who is one of the most popular, sought-after speakers today for having written a book. The Best Way to Rob a Bank is to own one. You kind of foretold the future, didn't you, Bill?
Unfortunate.
Yeah, unfortunate. You seem rather, it's sad news that you are sharing with everybody, but this book, and you can buy it anywhere right now, this book is a book that shows the interrelationship between the government and Wall Street, doesn't it?
Yeah, and Main Street to some extent as well.
Yeah. When you were writing this book, you bring out time and time again this systemic corruption that exists between these two institutions or three institutions. How do we change that? And is it going to change, period?
Well, it has changed. It's changed much for the worse. This crisis is vastly larger than the savings and loan crisis, and there are no regulatory heroes in this crisis that stood in the way. And ended up, as roadkill often, but stopped much of the worst of what would have happened in the savings and loan crisis. So in terms of fixing it, you got to do a bunch of different things. First thing you got to change is compensation, because executive compensation has become incredibly perverse. There's a whole big literature on how you ought to do executive compensation such that you better align the interests of the managers with the people that own it. And if you put a negative sign in front of that, that would be the real world. In other words, we do virtually everything almost completely the opposite of the way that it ought to be done. And that is the biggest single driver as to why you have much more pervasive frauds. Second thing is also compensation, but here it's to the professionals. The rating agencies' behavior in this crisis is an absolute disgrace. The outside auditors have continued their fine record of complete failure, as in all other crises. And the appraisers, now they're smaller fish, often they were pressured, but again, they haven't come up right. And to speak of our own profession, it's hard to cite any great legal heroes either that stood in the way and prevented these things. So We have to work on how we do compensation for outside professionals so that they're more independent and so that they actually bring their professionalism to bear instead of self-interest.
I'd take it a step further and say that when we talk about outside professionals in particular, and I think that's really one of the big pieces here. You know, when we had the internet bubble and we had Enron, Sarbanes-Oxley came into place, and we started to require certifications by outside auditors and by CEOs and CFOs of corporations for the public statements that were being made, in particular the financial statements. But one of the big problems with that, besides the fact that the pendulum started to swing back the other way toward additional deregulation, is that we didn't go far enough. And one of the things that Sarbanes should have done was it should have made clear something which this Supreme Court has done in the opposite direction, the negative, as Bill said, and that is you need to be able to hold professionals absolutely accountable for their actions. And if you're going to say to professionals like accountants that you have to certify what you do under Sarbanes, you need to hold them accountable to investors for the statements that they make publicly. You can't, as this Supreme Court has suggested, say, you know, we're not going to have aiding and abetting liability or non-speaker liability for folks that go ahead and do financial statements but don't do more.
You know, there's an old saying, you can pass a lot of laws, but if you don't enforce them, what good are they? You bring up Sarbanes-Oxley. Mm-hmm. As far as I've seen, there's really only been one major case and not a whole lot of cases pursued under these new laws, and that was the Richard Scrushy case. Mm-hmm. Sarbanes-Oxley, government lost. I haven't seen too many other cases after that fact where they hold, chief executives and outside vendors and outside contractors responsible, legally responsible. And I think, Bill, you keep talking about that. That allows them to think, I can get away with this, right?
Well, yeah, you asked earlier about systemic problems.
Yeah.
In criminology, we talk about criminogenic environments where you create pervasive incentives to have lots of criminality, and that's what we've done. So what we've done on the private side makes it harder to hold people accountable. That encourages crime. What we've done on the government side has been even worse. So very briefly, we transferred 500 FBI agents when 9/11 hit, from white collar to dealing with terrorism. Everybody can understand why you would do that, but nobody can understand why the administration refused to let the FBI replace those lost agents.
Right? What's your gut feeling about that?
Well, they did it for money and ideological reasons. Mm-hmm. It was a horrific mistake, and white-collar prosecutions are down dramatically over this decade, right? So you both hurt the private enforcement of the laws, and simultaneously you took an enormous whack at the public enforcement. We appointed people to run the key banking regulatory agencies who believed that regulation was evil and that it couldn't work. And so they came to press conferences with chainsaws mm-hmm. poised over the federal regulations to symbolize their intention to destroy regulation. Well, they succeeded. So if you got regulation, you got the criminal law enforcement, you got the SEC, you got private enforcement of the securities law, you do all of those things at the same time while creating pervasive incentives to do the wrong thing through compensation, and it's not a black swan event. This is not some weirdly rare thing. This is a series of intensifying crises, and until we fix these underlying things, we're going to get even worse crises, and we can't afford them.
And I think that's really the point, Steve. I mean, when we talk about this bailout and what's happened here, we kind of put the cart before the horse. The first thing we needed to do was fix these regulatory issues. You had, as Bill said, this raft of deregulation. We needed to put back into place appropriate regulation. You have weaknesses in Sarbanes or other places regarding public and private enforcement. We need to rearm the government, rearm private, lawyers and private citizens who are investors who can go forward and enforce these laws. The SEC can't do it all. They've filed countless briefs suggesting that securities lawyers, for example, act as private attorneys general, to have enforcement. We need to rearm. We need to deal with aider and abettor liability, provoke greater transparency at the corporate levels. And then once you've done those things, then you look at this and you say, okay, where does the money have to go? How much can we afford? And before we do that, of course, let's make sure that the bad actors who were responsible for this collective symbiotic behavior on the corporate side, one feeding off the other, whether you're a repackager or a regulator, issuing debt, etc., that those folks are gone before we start taking taxpayer dollars and putting them anywhere near these institutions.
I read that AIG, for example, one of the reasons that the government bailed them out was they insure 180,000 businesses around the world who employ something like, 10 million employees. They insure a lot of pension funds. And getting back to this too big to fail, had you let AIG fail, what do you think this country, the world economy, would be in today?
Well, I think that notion of too big to fail in AIG's case, for example, was really perception management. Somebody took a fact.
Not for real, then.
Not real. Somebody took a fact that they're the largest insurance entity or one of the largest entities in the world and tried to take that and graft it onto the issue of where AIG needed the money. The reality is that all those insurance subsidiaries that AIG owned that were insuring all these businesses and that wrote auto insurance and personal lines and other types of insurance around the globe are all perfectly healthy. They're not getting any of this TARP money. They're all extremely well capitalized or over capitalized and are wholly unaffected by what's at issue here.
Well, wait a minute, wholly unaffected. They're still connected to the same AIG financial products, and they would be vulnerable to the mistakes that they make.
No. This is, insurance is a different animal. It's very highly regulated. Each individual company has its own capital requirements that have to be maintained based on what it's underwritten, its own reserves, capital requirements, wholly separate from the AIG holding company and the subsidiary, the separate independent subsidiary.
Legally separate.
Legally separate in every way, that issued the credit default swaps that caused AIG to have this financial need. And that was all driven, for the most part, by the fact that the credit default swaps, which are a kind of insurance, were enabled, if you will, and I say a kind of insurance because
they are insurance.
They really aren't an insurance
No,
product.
they're really not insurance.
They should have been.
All right, they're just not. They, even in the pure form, they're not. But originally, credit default swaps came into being as almost a guarantee by AIG or other insurance companies of these mortgage-backed securities, and they were designed to be tied to them directly. So if you were concerned or didn't want to take a risk that you wouldn't get paid on your investment or you would lose your investment, you would buy this as a hedge and pay a premium for it, almost like insurance, but more like a guarantee. But then what happened was AIG said, well, we're not making enough money on that. So they started selling naked credit default swaps, meaning that there was no underlying investment to protect. Financial houses like Morgan and Goldman and others were simply buying CDSs as a bet on which direction the markets would go and whether there'd be failures on a basket of products or not without ever owning the product. So for a very small amount of money, they could get insurance for the whole thing. And, one of the analogies we talked about earlier, which has been in some of the articles that have been written, it would be like all of your neighbors buying insurance on your house.
Right. And if my house burns down.
And if your house burns down, you get your $1 million. And everybody in your neighborhood gets $1 million as well, even though they've lost nothing.
And that's systemic risk, isn't it?
It is, but it's more than that. Because in this case, the neighborhood that was buying that insurance were all of the other investment houses, the big investment houses. And when AIG, when things went the wrong way, they were able to collect from AIG on that bet. Now, AIG didn't have the money. And so the government came to AIG and said, okay, we're going to bail you out. But the reason the government bailed out this one small piece of AIG is because it wanted to get money, more money, to the investment houses.
And to the banks.
And to the banks. And it couldn't do it out in the open where the public could see it because the TARP money that had already gone out was tremendously unpopular.
Yeah.
And there was all this discussion about bailing out Wall Street, et cetera. So the way to do it was to push it to them through AIG. By doing that, you did two things. One, you didn't increase government ownership of the banks, the investment banks and the banks. You didn't do that because all you did was increase ownership in AIG, right? These funds flowed out directly. And you did it in a way the public didn't perceive the issue. So it was a tremendously interesting piece, all sold, perception management, under this guise of too big to fail. But the fail that was really at issue were all of these investment houses and others who were taking all that fresh capital in for their own purposes without the public knowing.
Now, we have a new administration in, President Obama. He came to office on the word of we need to have change, correct? Transparency. You like to call this perception management. I like to call it a lie. You don't mind?
Okay.
I think it's synonymous. So my question is, what has changed with the change of administration, and why is this continuing to happen, this mismanagement or this perception management? Why is this continuing to be broadcast to the world and to America? Is there some sort of relationship between the government and big business?
Bill, why don't you start and I'll pick up?
Well, the Obama administration in finance has continued the policies of the Bush administration in finance. And
No change.
Well, there have been some changes, but on the bailout, it's very similar, and indeed the people are very similar because Geithner was a principal architect with Paulson under the prior administration, and of course Geithner was made Treasury Secretary of the United States by President Obama. So in finance, on the bailout, you're seeing much the same of the failed policy continuing. So why do you continue failed policies when you come in saying that you want change? Well, look at the political contributions in terms of what the finance industry pays. And there are, they're incredibly open to both parties. They are bipartisan in every conceivable way. They give massive amounts to Republicans and they give massive amounts to Democrats. And so it's unusual to be able to find politicians that are willing to take them on. And again, this is bigger because Wall Street is much bigger, but it's a continuation of stories that we've seen elsewhere. It was efforts by Wall Street to gut many of the abilities to bring those private rights of action that we were talking about earlier. Some of that happened under Clinton, some of that happened under Bush in terms of at least the judicial appointees that he put in, were very supportive of cutting back the ability to have aider and abettor liability, for example. So that, both parties have the fundamental belief that they ought to serve Wall Street's interests. Unfortunately, Wall Street operates in a way that hurts the interest of America and its people.
So for many people that are listening to this and watching this program today, they've been under the misconception that Barack Obama, who came to Washington with change in mind, hasn't changed a darn thing.
Well, I think that's right. I mean, so far, at least in this context.
Yeah.
Can't speak to the broader context and leaving aside the politics of whether his policies are good, bad, or indifferent in other contexts. When it comes to this, I think Bill's right. I mean, you can go all the way back to look at, Rubin as Treasury Secretary during the Clinton years, and after that, Wall Street has traditionally been where presidents have looked for their Treasury secretaries. There's always been a tremendous tie between one and the other, and I think there will to some extent. But the problem really is not just money, which is part of it. Lobbyist fees have certainly, been a press for deregulation. But when we get into this type of a context where there is a failure, the government has to be able to understand where all of the risks are and be able to attend to all of those risks. And I think what we saw here was a lot of fear-driven response. I think to some extent we see continuation of policies because they were in place, but also because still there's a fear-driven response. We have to press Wall Street up. We have to do better. And my point, I think, and I think Bill's point as well, is that before you do that, you need to fix what's broken. And that on the one hand, that's regulation. On the other is if these investment houses, which, you know, or big banks like Citigroup or Bank of America and others, you know, are at risk of failure, well, we ought to attend to them like we deal with other bank failures. We ought to act to protect investors. If $250,000 isn't enough for depositors, we could easily have said, instead of putting TARP money out there everywhere, that we're going to up the FDIC's protection to $2 million or $3 million or whatever the appropriate number might be to protect all depositor funds. And then said, okay, now we're going to come in as regulators, like they did in the S&L crisis. And we're going to look at exactly what the assets are that you have in your hand, and we're going to look at what they're worth, and we're going to work this out. And if depositors need to get it, that's fine. And on the other side, the investment banking side of a lot of these banks, Bank of America has it, Citi has it, they all had investment banking sides. On that side, hey, we're going to sit there, and if that means that that part of the business fails and shareholders have to take a hit there, that's fine. But we're going to protect Main Street. We're going to protect people who went to banks for security on the depositor side. They're going to be protected. And then on the other side, we're going to deal with your failures, and we're not going to throw good money after bad.
Let me give you one important tidbit about AIG. In February of 2008, they said they'd done a severe stress test, and the worst conceivable losses would be $900 million.
This is AIG talking.
AIG.
Okay.
All right.
Was that
the actual, no, the actual losses appear to be roughly 200 billion. So they missed it by 200.
That's estimated
times.
now.
Yeah, that's the estimated. So roughly 200 times the alleged worst conceivable thing under a stress test.
Yeah.
So have some caution about these government stress tests.
Problems that I've seen is Secretary of Treasury Geithner talked about creating a bad bank, similar to the RTC kind of, and the ability of this bad bank to value some of these pools of mortgages. The banks, I've read, value these CDOs on their books at 91 cents on the dollar, whereas many of them might be worth far less than that. There's another complication with the servicing companies. You've seen how the workouts, as you're talking about, trying to work out a mortgage, like with an ARM, adjustable rate mortgage. One of the difficulties they had the servicing companies to go along with that program, because the servicing companies are often a totally different entity, and they don't want to change anything because they say they have an obligation to their investors. How do you see this working out?
First, IndyMac, we know, which sold liar's loans and sold over 200 billion of liar's loans to others. So those are out there somewhere. They suffered about 80% losses on those things. So that
What were
gives
the rating agencies then?
Well, they were giving them AAA ratings is the answer to what the rating agencies were doing on this stuff. In terms of servicing, that is a problem because it's often in the interest of the lender to renegotiate the loan when the only alternative is default. But the lender, because there is no lender really, we've so sliced and diced the interest in creating these CDOs that you're talking about. Often there's no one with authority to enter into a loan workout. And that's a real stupidity of the current system that we need to fix technically. That's something where some good commercial lawyers need to be brought into it. And we're not. And we're now 2 years after the subprime market collapsed, and we still haven't dealt even with the technical things that lawyers would be good at.
And that's one of the problems politically is that it's nice to stand on the steps of the Capitol and say, we're going to take care of all these homeowners. We're going to put these programs into place. But the reality is that the banks, the originators of these loans who still have the risk of loss ultimately, and that's where all this has come back, right? All these banks said, well, once we took it off balance sheet into off balance sheet entities, we no longer had a risk of loss. We no longer had to account for it. Well, of course, that was a fiction. They all had the ultimate risk of loss, either directly or by guarantees. But leaving that issue aside, when it comes to this issue, instead of sitting there saying, oh, everyone's going to stay in their house, et cetera, the answer isn't that. If you had a liar's loan or one of these, no-tell type loans or other things, you had no business being in that house. And perhaps you were victimized by certain lending practices. That should be dealt with at a state level. Let the state regulators and state AGs deal with those types of consumer fraud types of problems. When you're dealing
But that's
with,
been preempted by the federal government
I understand.
under the administration, so they
and-
can't.
And that's one of the problems.
Yeah.
We need to have state regulators, let them do their jobs. This notion, and this is one of the unfortunate changes, I think, of this administration, that we're going to ignore federalism. And instead of the states regulating these issues, who have the folks in place on the ground to be able to do the job, we're going to let the federal government, issue these edicts from on high that are wholly untenable in the real world. And that's, just for a soundbite. And that's where that's change that we need to put into place. We need to stop the sound bites. We need to rearm the states, let them re-regulate the securities, the insurance products, let them go after the consumer lending problems that are consumer lending problems. And at the federal government, we need to look at these banks and we say, okay, you're a depository institution, here you are. You sit here. You're not a depository institution, we'll deal with you in due course. And then let's look at the depository institutions. Let's look at what the assets really are. Let's protect the depositors at all costs, because they certainly shouldn't bear any risk here.
Sure.
And then, if shareholders ultimately have to, they should have recourse to the true bad actors here. And as I said before, that's a pretty big circle. And Bill's pointed out too. It's ratings agencies, repackagers. It's all the folks around that circle. But you have to start somewhere. And to get to the heart of this, you have to look at what underlies all this and underlying value. And if it's zero, if it's 80% losses like with IndyMac, whatever the number is, it is.
Yeah.
And it's time for us to take our medicine. The government shouldn't be bailing out the public side of these banks. It should only be protecting depositors.
I want to recommend again, go out and buy Bill's book. The best way to rob a bank is to own one, because a lot of the information that we've talked about today, and more so, is in this book.
Well, it's a great book and well written.
If you have one final word, both of you, to send to Washington right now, Bill, what would be your final word?
Authorize a Pecora-style investigation of what went wrong and put someone like the gentleman to my left in charge to find the facts.
And Andrew?
That's kind of you to say. From my standpoint, I think we need to go backwards to go forwards. I think we need to look back at the savings and loan industry, Bill's time of regulation there, look at what was done there, follow the lead that he's suggested in his book and other places, get underneath these things, and we need to stop mortgaging our children's future, for political sound bites, and we need to do it now.
I want to thank both of you for being on the show. I hope the information that we've all shared makes changes. Thank you again.
It's our pleasure.
Thank
Bill,
you.
Always a pleasure.
Thank you.
Thanks for watching. You can get more information about our guest and the issues at www.insiderexclusive.tv.